for 57,300 crore in December so far. The total investment this year has crossed 1.62 lakh crore. This is what the news is. There is a sudden increase in the foreign portfolio investment in India. So that is what the news is about. How the news is related to UPSC exam is, under prelims it is related to economic and social development. Similarly under mains it is related to GS paper 3 economic and development under a subtopic called Indian economy and issues relating to planning, mobilization of resource, growth, development as well as employment. Okay, let's move on to further analysis of the news. See, the FPI has injected an amount of 57,000 crore into Indian equity market due to political stability and at the same time the robust economic growth, that is the predicted rise of the GDP growth in India, and there is a steady decline in the US bond yield. So these are all the reasons which has contributed to the sudden spurt in the foreign portfolio investment inside the Indian equity market, and the total investment has surpassed 1.62 lakh crore this year. And what the experts have predicted is that in the coming months this FPI will be in the inclining only. Why? Because there is a chance that the US bond yield will get decreased in the upcoming months. So that is the reason why the Indian equity market experts have suggested, or they are expecting, that in the coming month there will be increased flow of FPI will be happening in India. Okay, let's move on to the analysis. What does this FPI is about? So the FPI are nothing but the investment by the non-residents in the Indian securities, which includes shares, government bonds, corporate bonds, convertible securities, or the securities issued by the trust, etc. So what advantages this kind of investment poses is, first and foremost, it will enable the organization to access or raise the capital apart from the convention banking industries. Secondly, it will enable high return to the investors. So the investors could able to gain some return of investment for the investment which they have done in the equity market. And thirdly, it is highly liquid. The investment that is being made by the investors is highly liquid when compared to other investments. So what kind of disadvantages it holds is, first and foremost, is the capital flight. If there is any kind of instability that is happening in an economy, or the political stability that is happening in an economy, means there will be sudden flight of the portfolio investment will be happening, that the investors could able to easily take back the investment or the money which they have invested in the equity market when compared to the other foreign direct investments or foreign institutional investments. And secondly, it is vulnerable to the currency risk, since the market has been invested by the non-domestic investors. So it will be mostly in the kind of dollars, euros, so on and so forth. So because of the investment by the non-residents in the Indian equity market, there is a high chance that this investment might get affected because of the volatile currency or the foreign forex markets. Thirdly, inflation risk. The increased inflation across India or across in an economy where the portfolio investment has been made also pose a threat to the investors. So these are all the advantages as well as disadvantages the foreign portfolio investment holds. So what are all the regulations that has been available in India to regulate the foreign portfolio investment? First and foremost is the regulator SEBI itself acts as the regulation for the foreign portfolio investment, and the SEBI has released a regulation guidelines, that is SEBI Foreign Portfolio Investors Regulation 2019. So all the FPIs will be regulated through this provision. Secondly, the foreign portfolio investors as well as the investment should also comply with the FEMA, that is Foreign Exchange Management Act 1999. Thirdly, The Income Tax Act 1969 also regulates certain provisions in relation to the foreign portfolio investment as well as the investors. So these are all the regulations that has been currently available in India to regulate the foreign portfolio investment. So what need to be studied further is we should be aware of what is FDI, which are all the components that constitutes FDI. Secondly, we should also be aware of what is balance of payment and which are all the components that constitutes balance of payment, and what is the impact the balance of payment crisis causes to an economy. Thirdly, we should also be aware of the structure, function as well as the mandate of the SEBI as well as RBI. So these are all the other areas which we need to be further aware of, and with this we have reached the end of this topic.